Today's highlights: contract open interest and reserves are rising, Bitcoin has climbed from 60,000 to 70,000, but the bull market score is down to just 10 points. AI agents have already started autonomously controlling on-chain wallets. Is this market rally an opportunity or a trap? Friday, March 6th, CoinBlockTV Chinese channel. Where is the blockchain? I'm Lucia. First, let's look at the most important crypto data headlines from the past 20 hours. Data shows that around March 3rd, Binance's Bitcoin open interest surged rapidly from $6.3 billion to $8.2 billion, an increase of nearly 30%. At the same time, the price of Bitcoin also rose from $66,000 to $72,000. When both price and open interest rise together, it usually indicates that new capital is entering the futures market, and derivatives trading is clearly heating up. However, as the most active platform at present, Binance's 24-hour derivatives trading volume is about $58 billion, so changes in its open interest often reflect market sentiment in advance. But in the past 24 hours, open interest has dropped from $8.2 billion back down to $7.2 billion, indicating that some leveraged positions have started to close and the market's heat has cooled off slightly. So from historical experience, this kind of situation is often just a breather during the upward trend and doesn't necessarily mean the market is about to reverse. Recently, Bitcoin trading volume on Binance has clearly become much more active. Data shows that in the past 30 days, the trading volume was about 425,000 Bitcoins, the highest level since December 2025. At the same time, there are still about 660,000 Bitcoins sitting on the exchange. If we look at trading volume together with reserves, the current liquidity ratio is about 0.64. This means that in the past month, about 64% of the Bitcoin reserves on exchanges have been traded or transferred. This indicator isn't about whether money is flowing in or out, but rather how quickly it's moving. High trading volume and high reserves indicate that there are both holdings and trading demand in the market. Historically, this kind of situation often occurs before the market chooses a direction. Everyone is balancing their positions, so prices may fluctuate at first, but afterward, larger movements tend to follow. Recently, gold has performed very strongly, with an increase of about 76.4% over the past 12 months. In this macro environment, on-chain digital gold has also become popular. Tokenized gold such as Pax Gold and Tether Gold now have a combined market capitalization of over $6 billion. On-chain data has also revealed another change. The size of Pax Gold futures orders is getting larger, and on March 1st, there was even a massive order of 559 Pax Gold tokens. At the same time, the daily average trading volume of Binance's Pax Gold USDT perpetual contracts has reached $200 to $300 million, indicating that market liquidity is already quite high. Generally speaking, when order sizes keep increasing, it often means that institutional funds are starting to enter the market and allocate assets. Simply put, as global uncertainty rises, some capital is once again buying gold through on-chain assets. Please like and turn on the notification bell. We will monitor news updates for you 24 hours a day. Our channel takes a macro perspective and through 15 minutes of in-depth integration helps you quickly grasp major changes in the digital asset field and enhance your understanding. Let's take a look at today's news. Last night, Bitcoin fell from $72,300 all the way down, reaching an intraday low of $70,658 around 1 a.m., a drop of 2.3%. By this morning, the price had stabilized a bit, fluctuating around $70,900, but overall it was still suppressed below the key $71,000 level. By comparison, Ethereum actually held up relatively well during this round. Last night, it slid all the way down from $2,134, but found support and stopped falling near $2,055. This morning, it rebounded to around $2,073. Although it also dropped about 2.9% during the day, it didn't plunge further like Bitcoin did. But that being said, even though Bitcoin has finally climbed out of its slump at $60,000 to around $70,000, the market outlook still shouldn't be too optimistic. The price returning to $70,000 doesn't mean the bull market is truly back, because this is more like a temporary rebound after a significant drop. There are still quite a few conditions missing before we see a genuinely strong market. According to on-chain data provider CryptoQuant, the bull market score index is out of 100, but it's currently only at 10, which is near a historical low. Both the fundamentals and technical indicators still point to a bear market environment. Therefore, the current market movement is more likely just a rebound within a bear market, rather than the start of a new upward cycle.
It has been a rough fall right after a nice rise. Remember, we actually touched 73,000 before that rise up to 126. And I think there's more than a 50% chance, this is how I see it, that we'll reach a new all-time high in 2026.
From the perspective of capital flows, the key issue in the market is still the lack of spot demand. Data shows that at the beginning of 2026, there was a net outflow of about 136,000 BTC in Bitcoin spot demand. Recently, although this has narrowed to about negative 25,000 BTC, indicating that selling pressure has eased somewhat, demand is still in negative territory, which means the market as a whole is still experiencing net capital outflows. Based on the current data, there are roughly 3 possible scenarios for the market. The first is a bullish scenario. If spot demand turns positive and US stocks stabilize, Bitcoin may find support at $71,000 to $73,000 and retest $75,000. In a neutral scenario, if outflows narrow without positive demand, Bitcoin may range between $70,000 and $73,000. In a bearish scenario, if macro conditions worsen and outflows resume, $56,000 to $60,000 may become the key support level. Ethereum has been relatively resilient in this round, but its overall trend will still follow Bitcoin. If Bitcoin declines further, it's still uncertain whether Ethereum can hold the $2,055 level. With the bull market score at only 10 points, the market remains quite cautious about every rebound. Now let's talk about AI. AI is evolving from being able to answer questions to being able to take actions on its own. On February 26th, NVIDIA CEO Jensen Huang announced at the Cisco AI Summit that the inflection point for agent-based AI has arrived. This kind of AI can autonomously make plans, call on tools, and carry out multi-step tasks. It no longer needs you to give instructions. It knows what to do on its own. The connection between this and the crypto industry is actually more direct than people might think, because blockchain itself is a programmable and automatically executable financial system. When AI learns to act independently, the next thing it might take charge of could be your wallet. But there is still one issue that cannot be avoided. Once an on-chain operation is executed, it cannot be undone. After AI agents enter Web3, they can autonomously initiate on-chain transfers, call DeFi contracts, execute trading strategies, and manage wallet permissions, achieving efficiency far beyond humans, but the risks are equally amplified. The key point is irreversibility. Once an on-chain operation is executed, it cannot be rolled back. Yue Xia, the head of Meta AI, once discovered during testing that the AI agent system went out of control, mass deleting emails and ignoring stop commands. She could only cut the power manually. Emails can still be recovered, but once on-chain assets are transferred, it is very difficult to get them back.
These are all fundamental things that now, in the terminology of agentic AI, you've heard about. Isn't that right? Tool use, research, retrieval, augmented generation, which is grounded in fact, memory. These are all things that all of you, in the context of discussing agentic AI, are familiar with.
Vitalik Buterin, the founder of Ethereum, has commented rather coolly on this, saying that the longer the AI execution cycle and the less human intervention there is, the more likely the system is to optimize in a direction you don't want. For example, if the goal is to maximize this week's returns, the AI might invest funds into unaudited, high-risk protocols. The logic is sound, but the outcome could be disastrous. The Ethereum Foundation has already established an AI team, DAI, in September 2025 to research the governance and security boundaries of AI on-chain. Agent AI entering Web3 is not just a concept, it's a reality that is already happening. The challenge lies in the inherent tension between the irreversibility of blockchain and the autonomous decision-making capabilities of AI. To address this issue, researchers have proposed 4 principles. First, minimum privilege. AI must not be granted full control of the wallet by default. Second, human confirmation. This refers to mandatory manual approval for large transactions. Third, transparency and auditability, meaning that every action must leave a log. Fourth, sandbox rehearsal, which means simulating the results before executing on-chain. The greater the capability, the higher the cost of losing control actually becomes. This is not about opposing AI, but rather saying that the next security war in Web3 has already begun. Justin Sun didn't lose a cent and walked away unscathed. Was there any deal between power and money? Mining companies are collectively selling coins to bet on AI. Who will be the ultimate winner in this game? Recently, let's talk about a hot topic. 3 years ago, Justin Sun was sued by the US SEC, accused of wash trading and illegally profiting $31 million. And 3 years later, this lawsuit has finally come to an end, and the outcome is somewhat unexpected. His company paid a $10 million fine, but he himself didn't pay a single cent. All charges against him were dropped, and not only that, They were permanently dismissed and cannot be brought up again. For him, this was a very impressive victory. But there's one detail worth noting. During the trial, Justin Sun invested a total of $75 million into the Trump family's crypto project, World IFE, and soon after, the case was settled. So are these two events actually connected? The SEC says no, and Justin Sun also says no, but Democratic lawmakers couldn't sit still and publicly accuse the SEC of engaging in a pay-to-play scheme. That's the situation as it stands. Today, we're going to lay everything out and help everyone understand exactly what happened. In March 2023, under the Biden administration, SEC Chairman Gary Gensler sued Justin Sun, accusing him of manipulating the market through 600,000 wash trades and illegally profiting $31 million. But in 2025, after Trump took office and Atkins took over the SEC, the situation changed rapidly. Within a month, both parties jointly applied to suspend the proceedings and entered into settlement negotiations. In the end, the company paid $10 million, with zero fines for individuals, and all charges were permanently dropped and could not be brought up again. This was not an isolated case. During the same period, more than 12 cases against Binance, Coinbase, Kraken, and others were also successively dropped, signaling a complete shift in the industry's regulatory approach.
I believe the SEC has lost a lot of credibility with those legal actions, right? When they first took legal action against probably a few exchanges, people felt like the complaints they brought probably had some foundation. But after they basically went after everyone, every player in the space, I think eventually the SEC will face pushback.
There's a detail in this lawsuit that is worth paying attention to. During the trial, a wallet associated with Justin Sun transferred 75 million USDC to the Trump family's crypto project, World Liberty Financial. The on-chain data is clear and verifiable. Shortly after, the two parties reached a settlement. The company paid $10 million, and Justin Sun personally walked away unscathed. 3 Democratic congressmen immediately wrote to SEC Chairman Atkins, directly accusing this of being a transaction of power and money. Both the SEC and Justin Sun have denied any connection, but the sequence of events is right here. It's up to you to draw your own conclusions. In fact, the significance of this matter has gone far beyond Justin Sun himself. It means that during Trump's administration, the regulatory environment faced by the crypto industry actually underwent a structural change. The previous approach during the Biden era, setting rules while simultaneously filing lawsuits, is now being replaced by a more relaxed and friendly regulatory attitude. For the entire industry, this is certainly a positive development, but it also brings new problems. When relaxed regulation and political money overlap so closely, are the rules of the game really written for everyone or just for those within a certain circle? That letter from the Democratic Party represents exactly this issue. There isn't a simple answer to this question, but it's something everyone should keep in mind. Let's turn our attention to the mining companies. The mining companies are doing something new. They're exchanging freshly mined Bitcoin for entry tickets to AI data centers. Last month, CleanSpark produced 568 Bitcoins and sold 97% of them, cashing out $36,600,000. They're not the only ones. Riot also sold 1,818 Bitcoins. Core Scientific sold about 1,900, and BitDeer completely emptied all of its reserves. There's a logic behind this that's quietly changing the entire mining industry. As electricity and computing infrastructure become the most sought-after assets in the AI era, the bitcoins held by mining companies no longer seem as valuable. Instead, they have become chips for transformation. But let me say this up front, this isn't a bearish outlook, but rather a redistribution of capital. Today, let's clarify what this migration means for the price of Bitcoin.
CleanSpark produced 568 BTC in February, sold 553 of them, cashing out $36.6 million, with a sell-through rate of 97.4%, and still holds 13,363 BTC on its books. This isn't an isolated case. Riot sold 1,818 BTC, cashing out $161.6 million. BitDeer liquidated all of its reserves. Core Scientific sold about 1,900 BTC, cashing out $175 million, and secured a $500 million credit expansion from Morgan Stanley to develop AI. There's only one logic. If you have land and electricity, selling coins is the fastest way to raise startup capital for transitioning to AI.
We have more hash rate domestically than anybody else. We have a top 10 Bitcoin treasury. If you look at bitcointreasuries.net, we mined it all. We didn't buy it. So we didn't leverage up and borrow money to buy Bitcoin. We mined Bitcoin at, like I said, at greater than a 54% margin. And we've stacked up $1.5 billion worth of that Bitcoin. And, to, I guess, the last point in the comment where we talked about dilution.
Heavy miner selling boosts short-term exchange pressure, but stops once reserves are gone. The exception is Mara Holdings, holding 53,822 BTC. This week, the VP of the second largest corporate holder confirmed their HODL strategy remains unchanged. While the industry sells, leaders are staying put. This divergence determines the upper limit of the upcoming supply pressure.
This wave of Bitcoin selling by mining companies is actually not a panic move in a bear market, but rather a proactive reallocation of assets. They're selling Bitcoin to buy more expensive things: electricity, land, and AI computing infrastructure. For the market, this means increased selling pressure in the short term, but in the long run, these mining companies are transforming themselves from simple miners into AI infrastructure providers, holding scarce power assets. It may take 2 or 3 years before the winners and losers of this transformation become clear. But one thing is certain: Bitcoin will always be the core asset in this story.
Kraken has received approval from the Kansas City Federal Reserve and is now officially connected to the Federal Reserve's payment system. The banking industry is unhappy, while the crypto community is excited. After all, this door has never been opened to crypto exchanges before. XRP failed to break through the $1.45 resistance level and immediately dropped by 3%. It is now holding at the $1.40 support. There was high trading volume, but no price increase. Is this really the top, or is it just building momentum? The market still hasn't made up its mind. After being valued at $25 billion, HKEX announced that it will integrate a social network into its trading app, combining trading, community, and market data into a single platform. Exchanges alone aren't enough to sell anymore. They're selling social features now. Short-selling firm Cooper Research has publicly shorted Ethereum, claiming it has been damaged and that Vitalik is still selling coins. Bitmine, a subsidiary of Bitmain, was also named because of its heavy holdings in Ethereum. According to a Chainalysis report, the scale of on-chain sanction evasion will surge by 700% in 2025. Russia, Iran, and North Korea have transferred over $100 billion through stablecoins and hacker funds. Blockchain is transparent, but that doesn't stop some people from using it as an underground bank.
Many people are curious. Why is it that after surviving the bear market, some come out as winners while others end up empty-handed? The answer isn't luck, it's about what you actually did during your lowest point. Most people choose to lie flat and wait for the wind to change when the market is down, but a few work hard to learn, study the data, and figure out the underlying logic during the downturn. When the bull market really arrives, the former are still waiting, while the latter have already gotten on board. The workplace is actually the same. When companies are laying off employees, the industry is in a downturn, and colleagues are lying flat. It's those who quietly improve themselves who are the first to be snatched up when the next round of opportunities arrives. A low point isn't the end, it's your ticket in. So, don't choose the easiest way out when you should be accumulating experience. All right, that's the in-depth breakdown for this episode. Our channel has always focused on the core narratives and value discovery in the digital asset space. If you agree with our logic, feel free to stay updated with the latest news and enable real-time notifications. If you want to access higher-level research reports, you can follow our advanced channel. From Monday to Friday, we also share in-depth reviews of market cycles, capturing certain opportunities within trends. See you tomorrow.